Yes, there it is. Okay, so yeah, they've changed the software. It used to be that it would automatically record until you told it not to. Now it's doing exactly the opposite. So yes, I am having to get a little bit used to this. But anyway, last week's worked, and I was surprised because the computer I was using was very old and really on its last legs. So this is different. It's not just a new computer, but it's a Mac instead of a PC. And whenever you do that, switch from one to the other, you really have to keep your eyes open because you never know what little surprises will be awaiting for you. So anyway, what we have here this week in week 3 is a very intensive look at swaps. Now, if you look at our Brightspace, you'll see that there is actually a Excel document here called swaps template. And you can see that a lot of it's already been filled in. In fact, all of it's been filled in because we don't have all night. And if we try to do it from scratch, it would take a very long time. So this way, it's already pretty much set up for us. And we can just go through and see what this is all about. And then once that's done for the assignment, there's a template, which is very similar to this one. Actually, I'll need to download this. Or not. I'll tell you what, let me just get it off of my hard drive. So the assignment template, it looks very much like this one. So in other words, the purpose of this is that you can fill it in very quickly and easily, just using this as a guideline. All right, so in other words, there's so many details that this way it's already organized for you. And all you really have to do is watch what's happening here and make the necessary changes to your template, your assignment template, and then you will end up with the correct results. You've got here on your assignment an interest rate swap. I have to get used to this Mac mouse. It's very different than a PC mouse. And the FX or foreign exchange or currency swap. Okay. So that's why that's in there. So this way it'll save you a lot of time. And you can just follow along with exactly what we're doing here. Let's see. Okay. So I've had a request to go over last week's notes a little bit. Does anyone want to do that right now? Okay. So what questions do you have? Okay. I guess in order for me to download this stuff, I have to save it somewhere else. Like I said, I'm still getting used to the Mac. All right. So last week was the forward contracts and the futures contracts. And I think I put a little table down here somewhere. Yeah. And one thing I want to point out here too is that sometimes, oh, there's a hand. Go ahead.
Yeah, hi. I'm kind of struggling with the mechanics of the forward contract, where if you believe that the price is going to rise, you go long in the contract. Is that correct?
That's right.
So I understand that part. The other part I don't get is when simultaneously you're selling uh when it hits the price, whatever targeted price you have, you're selling it at the same time, and I'm having trouble with that concept.
Okay. Yeah. I am.
And the same goes if it's a short sale, then you would buy it back at the lower price. So it works both ways.
So which example were you talking about?
Just forward contracts in general, any of the examples, while there's actually like two transactions going on at the same time, which I having trouble comprehending that.
Oh, you mean the underlying and the forward contract itself.
Exactly.
Yeah. Hold on one second. I'm noticing something here that I'm finding very concerning. This is the PDF file that you're finding in your Brightspace. And I notice there seems to be, for some reason, a lot of blank space in here. I am not sure why that's happening. Let me open up. This is from last week. what that is all about. And again, remember too, everything that I wrote here was originally done on a PC, and this is a Mac. Maybe that is what the problem is.
It seems like you leave some blank slides that you actually type in
Oh.
manually as you go along.
That's it. That's it. You know why? Because those are the pages where I did all this handwriting. I really thought that when you saved a PDF file, it would look exactly like that. Yeah, this is very strange. Because I thought that was the whole point of PDF, that whatever you do on a PC would look exactly the same on the Mac. And now I'm seeing that maybe that's not the case. Let me do something here. I'm going to save this. I'll get back to your question, Dory, but I'm just very concerned about this now because the purpose of writing in there is to give you that extra information. And if it's not popping up, then I wonder what's the point. Why do we have PDF in the first place? Okay, so I just ran it again as a test. See, no, this time it worked. So the problem is not with PDF. All right, you know what I'm going to do, just because this is going to be a problem. Does anyone here use a Mac?
Me,
Have you found that there's huge gaps with blank slides in there?
yes, yes. And I wanted to look at the examples, but I couldn't.
This is really annoying the crap out of me because that's why I thought we had PDF in the first place. So that is not ever going to be a problem. So yeah, clearly this one. Wow. Let me look at this one. Wow. All right. Let me just try this one too. Okay, and then we'll open it up. So this is the one that we did last week, where I have all the handwriting in it. Jesus. See, it's fine. Now, all right, here's what I'm going to do. I'm going to delete whatever's in Brightspace. These two in particular. Let's get rid of this one. Does anyone see a delete button anywhere? I don't
Maybe on top where there is plus new unit, no, next
Oh,
to
here it is. Here it is.
Oh,
Now, does anyone understand this dialog box? What exactly are they saying? Remove the content view. Remove the topic.
It looks like one of them permanently deletes it and the other one, I guess, stores it somewhere in case you want it again, I guess.
Oh, well, that was the most poorly written dialog box I've ever seen in my life. I had no idea what they were talking about. All right, so what I'm gonna do is put these back, the ones I just created. One of these must be the right one. I've been doing it all along. Oh, add existing. Who writes these buttons? I mean, why would that be the one that you would think is? This is absolutely unbelievable. All right. I'll put this one in here. Oh, God. Now let's just scroll through it and see if that gap down there. No, it's all back. So I don't know what happened. I don't know where the issue was, but all right. Well, at least now I know. And so I can check. This is what I get for not checking. It's like you create a PDF file, you post it up there, and it doesn't occur to you to double check and make sure it worked out correctly because you figure it works correctly. All right, so let's get the other one. And then we can get back to where we were. Okay. So we'll unhide this one. Okay. So it appears to be there. All right, so. Oh, thank God it's there. All right, here we go. So let's get back to where we were. Now I just realized I'm missing my tablet. It's in the other room. I'll be right back. I'll just go get it. Hold on. And then I can write on the screen. That's why I need it. The Mac doesn't let you write directly on the screen. It doesn't have that capability. It never has. So, all right, but I'll be right back in 1 second. All right, I have it.
Did you also create a Word document last session where you were also taking notes or?
Oh, let's find out. I may have. Let's double check. I may have forgotten to put it up there. We have arbitrage example. All right, I'll sneak that in here.
Thank you.
Yes, I'm glad you reminded me. All right, here we go. All right, so I should be able to draw right on the screen here. But, oh, for Christ's sake, I probably have to install software on this damn thing. All right, all right, I'll just forget it for now. So we'll just do it. I'll just type. All right, so let's say, for example, an importer needs to buy 100 ounces of gold on March 1st. Okay, so this would be your classic example for a forward contract. The spot price is $1,500 per ounce. Okay. the importer is buying, so he is worried that the price will rise by March 1st. So how do you get around that problem? He enters into a forward contract, buy gold on March 1st. And let's just say that the price that he's quoted is $1,520 an ounce. Right? In this case, it's slightly higher. So now what this means then is that on March 1st, he will pay 100 times 1520 equals $15,200. Sorry, 152,000 for the gold, regardless of the market price. Okay, so there's a contract locks in the price at which you can buy the gold. So we don't care anymore what the spot price is. If it goes up, we save some money. If it goes down, well then, you know, we could have saved money, but we have to consider that to be the cost of buying insurance, which is what we've done here. So if the company is really worried about the price risk, then they may decide that it's worth their while to buy or enter into this contract, because it means that they don't have to worry about the price going up. If the price goes down, well, what are you going to do? So it depends on the risk preferences of the importer. If they're willing to take a chance that the price might go down, they might go ahead and just not hedge their position. Or if they have reason to believe that it will go down, they might not hedge their position. But if they're not that's convinced that the price will go down, they may say, well, you know, maybe we should just lock in the price now, even if it means we might have to pay more for the gold than we would otherwise have. So it's just like an insurance policy. You know, when you buy an insurance policy, you know that they're not going to give you your money back. You know, it's like even if you never use it. So it's the same idea. So if you're selling though, oh, and by the way, because we entered into a contract to buy gold, I'll just put in parentheses, this is a long forward position because we're buying. Now, an exporter, let's say a gold mining company, needs to sell gold on March 1st. They're just on the opposite side of this. Spot price is 1,500 per ounce. Well, this is an exporter then. The gold mining company wants to avoid the risk that the price will go down. For 1520. Okay, well, and then this is a short position. And then on March, and this one I can just copy it because except that he'll collect. He's the seller. So he will sell or receive 152,000. And in fact, these two could be the counterparties. Well, actually, I shouldn't say that. Usually the counterparties, at least one of them is a financial institution, but in principle, any two counterparties that can agree on something can get together and enter into a contract. So they could theoretically be the counterparties, but usually one side is some kind of a financial institution, a brokerage house, or, you know, an investment bank. It would be kind of unusual that the buyer and the seller would actually enter into this contract, but it's not impossible either. It's just that, you know, you wonder how they would find each other. And then you also have to worry about credit risk. So because there's credit risk with forward contracts, normally at least one of the counterparties is a major financial institution. But theoretically, it could be, this is something that could be arranged between any two counterparties. So those are really the two cases you might run into with forward contracts. Now, you can also use them to speculate. Like maybe you're not even involved in the gold market at all, but you think gold is going up and you want to buy it at a fixed price so you can sell it at a higher price down the road. So a speculator who expects gold to rise would enter into a long position to buy the gold for 15, 20. And if the price rises above that, on March 1st, the speculator will make money. Why? Because he can use the contract to buy the gold and then sell it in the market at the higher price. A speculator who expects gold prices to fall would do the opposite. Okay, yes, go ahead. Oh, I think
Maybe that's where I was misunderstanding it. When I read the words, he would then sell it. I thought it meant short sell it, but you're saying that he takes the commodity of gold because now he owns it and now he's selling it into the marketplace and making an additional profit? Is that?
Yeah, like you use your contract to buy the gold and then you sell it into the market to somebody else who will pay you the market price, which is presumably higher. Like you're in the business where, let's say you're in a position you can buy or sell gold. You might even be a gold dealer. And so the contract is locking the price at which you could buy the gold. So you actually take delivery of the gold to the contract and immediately turn around and resell it to somebody else.
So I guess the goal, if you're going long, you buy it at a certain price, but you're hoping that the spot price is higher than the forward price, and then when you own it, then you could sell it at the spot price, which is higher. Is that the mechanics of it?
Yes, that's exactly what's happening. You actually take physical delivery of the gold and you immediately turn around and sell it to somebody else at the higher market price, which, let's say it's $15.50, then you can sell it to somebody else for $15.50, and so you'd make $30 an ounce. So there isn't really, you're doing two things. You're making a forward transaction and a spot transaction with the same gold. Okay, good. All right. So now we can start to take a look at the swaps. Now,
I think you're getting frozen. I can't hear anything.
In effect, a swap could be thought of as a portfolio of forward contracts that expire at different points in the future. So in a lot of ways, that's all it is. It's just a series of forward contracts, although it can also be thought of as a type of bond as well, because it guarantees certain fixed payments in the future. And in fact, one of the pricing strategies that we'll be looking at is to treat your swap as the exchange of one bond for another one. And what you're effectively doing when you price the swap is calculating the difference between those two bond prices. Okay, now, by the way, this concept of forward contracts will continue to be important in this chapter, because one of the strategies, as I started to say, is for pricing them is to treat it as a series of or portfolio of forward contracts where they're all the same except for the maturity date. All right, let me just finish this real. All right, good. All right, I'm going to actually save this real fast before I lose it, because somebody may want to see this. I'll just call it hedging example. And today's date, of course. That's how we know when this was done. All right, so we'll put this away and we get started with swaps. Now, we've already discussed swaps to a certain degree. And, this is 2. We don't want that anymore. All right. Session 3, here we go. So primarily, we're going to focus on interest rate and currency swaps with the understanding that there are many other types as well. These are over-the-counter products. So just like with forward contracts, they can be completely customized to the needs of the counterparties. But they also entail a certain amount of credit risk. So the two most important ones are interest and currency swaps, but there's several others that we might run into. So here, what are we trying to do? We'll look at their key features. We'll try to understand how they're priced in the market, because every day that goes by, their price changes. Between the two counterparties, the position of one is increasing or improving, and the other one is decreasing, and by the same amount. So in other words, it's like if I'm gaining $1, the counterparty is losing $1 and vice versa. So the price actually represents the difference between the values of the two positions. Now, what do we want to know how they're used for hedging purposes, and what other types of swaps are available in the marketplace. So an interest rate swap, which is really the first, these probably were the earliest in the United States, at least. And really what you're doing here is you're trading cash flows based on the difference between two different rates of interest. Typically, one of those rates is fixed, and one of them is what we call floating, which simply means that it resets every so often. Like, for example, if we allow the fixed rate to be, I don't know, the Treasury, 30-year Treasury bond rate, and the floating rate side is the 3-month Treasury bill rate. Well, clearly the Treasury bill rate is going to change every on a regular basis, whereas that 30-year Treasury bond rate is going to be locked into the contract. So also what we need to do is specify what's called the notional principal. That's the amount of money on which the interest payments are based. So let's say you enter into a swap to agree a fixed for floating rate of interest. You have to specify what dollar amount this is based on. And that makes obviously a big difference. So let's say that the amount is $1 million. That will determine how much interest is paid back and forth between the counterparties. And that'll be very different than if the notional was, let's say, $1,000. So the notional is simply the amount of money that determines how much interest is actually being paid. Now, the most popular type of interest rate swap, as I said, is the fixed for floating rate swaps. Now, this is kind of a sad story, because up until very recently, the floating rate in a swap like this was typically based on LIBOR, which I guess it still exists. LIBOR stands for the London Interbank Offer Rate. Now, it turns out that in London in particular, it's possible, even easy, to buy, or I should say, deposit your funds into different accounts denominated in different currencies. So in other words, let me just get another document out here. We're going to introduce what are called the Euro currency markets, or market is where bank deposits are held outside the country of origin. Okay, in other words, euro dollars are dollar deposits held outside the United States. Euro yen or Japanese yen deposits held outside of Japan. Okay, so all the major currencies are available in this market. So in other words, it's just like a huge market where it becomes possible to borrow and lend funds that are not necessarily denominated in your own currency. So if you're a multinational corporation, sometimes you may want to borrow one currency and lend another. You know, it depends on what kind of revenues you're earning, where they're coming from, what your expenses are denominated in. You can easily imagine that the same company can have revenues coming in many different currencies, especially if they're doing business in Europe. And maybe their expenses are also denominated in many different currencies. So it's very convenient to be able to keep funds available where you are able to keep the currency, let's say, let's say you're an American company that does business in Japan, it may be convenient to hold yen deposits and earn the Japanese yen rate of interest. And so the euro currency market is actually quite large. And it came about basically in the 1950s. So what happened was in the 50s, of course, the US and the Soviet Union were involved in the Cold War. And supposedly Stalin was still alive at the time. And, he's basically stole everything that wasn't nailed down in the Soviet Union. So he had enormous bank deposits that he kept in the United States, actually, in American banks. And he was always worried that, one day the United States government is going to seize those deposits because to punish him for whatever he was doing. So he thought, why don't I move them into London? But I really want to keep my funds in dollars rather than pounds. So he approached some banks and made the arrangements, and the bank said, sure, we can do that for you. We can hold dollar deposits, but if we do, you're going to earn the dollar rate of interest, not the British pound rate of interest. And so once people saw what had happened, then other institutions decided, hey, that sounds like a great idea. Why don't I try to keep foreign currencies in a bank account in London, really for convenience, because I might be a multinational corporation, but it also helps me evade banking regulations in my own home country. So in other words, euro dollars that are kept in British banks are not subject to US banking regulations. Okay, the US government can't get their hands on your deposits in Great Britain unless, now, of course, if you're involved in international crimes and the British government agrees, they can then, grab your money. But in general, American banking regulations do not apply to dollars that are deposited in other countries. So you might want to simply avoid US regulations. You may think that you can earn more interest in one of these accounts. So it's a huge market. In fact, maybe we could find out how big it is. How large are the euro currency markets? It says here $14 trillion. Although, of course, that's just an estimate because these are private accounts. Okay. This is not a very good article for Investopedia, I must say. So it's the money market. Now, money market means that these are short-term deposits, okay? Like 3 months, let's say. And this is currency held outside the country where it is legal tender. It is used by banks, multinationals, mutual funds, etc. They are designed to help us get around domestic regulations, maybe, forgot about that, taxes, and also maybe earn a little more interest this way. And so euro dollars, as I said, are dollar deposits held outside the United States, typically in London. And so there exist interest rates that are paid for each currency. Used to be LIBOR. I don't know what's happening with LIBOR. I guess maybe it doesn't exist anymore. All right, let's do this. What rates are replacing LIBOR?
I believe it's SOFR, SOFR.
That's for the dollar, yes.
That's for the dollar.
All of them, it used to be easy to keep track of it. There'd be a dollar LIBOR, there'd be a Swiss franc LIBOR, there'd be a yen LIBOR. Now they all have a different name. So the dollar LIBOR is being replaced by the secured overnight financing rate, SOFR, which basically is the rate. What will happen is if one bank needs to borrow from another one. In a case like this, the transaction is collateralized by a treasury security. So a bank says, I need to borrow money. I will give you one of my treasury bills, and I'll promise to buy it back tomorrow for a slightly higher price. And so this way, the lender has this treasury bill as collateral. And if the borrower doesn't buy it back, they can sell it in the marketplace. So it's a very low risk type of loan. And so because of that, the rates that are being paid are also quite low. And so for US dollar, euro currency deposits in dollars, That's the rate that is being used instead of LIBOR. But the others have their own different names. So okay.
Are you looking for the sterling LIBOR replacement?
Yeah, I'm looking. Yeah, I was
That's
hoping to
called
find
Sonia. That's called Sonia.
Oh, you have it there?
Yeah, it's called Sonia. It's so I think it's like overnight something, but it is SONIA.
Okay, that was a bad idea. There it is, sterling overnight index average. Okay, this would be the one that they're going to use, or if you have euro sterling, then you're going to earn the Sonia rate instead of what in the past it would have been called British pound LIBOR. Okay, but I was hoping that somebody would have put together a table. Now you see, this is meant to be the entire history of Sonia, and it looks like it only goes back, wow, to March of 22. No, wait a minute. Some of these goes back to 2012. Oh, here we go. LIBOR alternative. So Sonia is for the pound or sterling. Oh, no. Saran is for Switzerland. Okay. SOFR is ours. That's the US. And you notice how it says here is the average interest rate for secured loans issued in US dollars with a maturity of 1 day. Okay. In other words, it is just overnight. That's what it's for. It's a single overnight transaction, a one-night loan of a treasury security in exchange for a small amount of interest. Now, these are annual rates, by the way, if you're looking at them, but like 4.55%, that's for a whole year. For a single night, the amount would be very, very trivial. What else do we have here? Tonar is, oh, that's Japan. Okay. And then finally, we have Esther, and that would be for the euro. So now what this is all about is that at this point in time, if you entered into a swap with one of these currencies, the floating rate side would be based on one of these brand new interest rates instead of LIBOR, which had, it was, LIBOR had been used for all those decades. And all of a sudden, there's a scandal involving several major banks, including Barclays, where the traders were manipulating the rate to basically make money at the expense of their customers. So then it became clear that it was just too easy for this to happen. So now these rates really can't be manipulated. And that's why we're replacing them with these rates. Now, I don't know. This is good. This is the first time I've ever, you know what else I've never been able to find before? Just the actual numbers. Like right here, this is, these are the rates with different maturities. And then they've got, God, this is unbelievable. I've been looking for this forever. Oh my God. I'll tell you what, now this is, I don't know about you guys. When I find a website this important, I'm going to do two things. I'm going to put it in the chat room in case you want to look at this, but I'm also going to email it to myself because I know that I'll never find it again. Never. No matter what I do, I will never, ever find it again. Okay, where was I? No, I need, okay. You wouldn't think it would be such a pain to find this, but some things, are surprisingly difficult to locate on the internet. It's just beyond belief sometimes how difficult it is to find some of this stuff. You think it would be all over the place, but that's just not the way it is. There it is. Okay, so this gives you what you need to know. Now they're still publishing the LIBOR numbers, but they're just not being used. You can still, I suppose you could still find a bank that offers LIBOR rates for deposits, but yeah, you just don't see it very often. This is Esther for Europe. By the way, did you notice that the Japanese LIBOR rate for 3 months is negative 0.02617%? Japan sometimes has negative interest rates because their inflation rate is so low that sometimes the rates sneak down into negative territory. But they rarely. Oh, look at this. Tonar is -2. That would be that is Japan. That's why. Okay. And then they've got links to explain. I love this website, globalrates.com. Jesus, where has this been all of my life? All right. Well, we found it. But so this is what's taking the place of LIBOR. But the bottom line is these rates are periodically going to change. So they could be defined as floating rates of interest. Okay, so forget LIBOR now. Those other rates will take its place. But as long as the rate changes periodically, we can use it as a floating rate in our different financial securities, especially interest rate swaps. Now, because we typically have a fixed and a floating rate of interest, the fixed side is often called the swap rate. Okay, you hear that used in Hull's book. The word swap rate is the fixed rate side because that's the number that applies throughout the entire history of the swap, whereas the floating rate will change pretty regularly. So the word swap rate indicates the fixed rate. So here's a very simple example. A corporation issues $100 million worth of debt with a maturity of 5 years. Now, they have to pay this. They're offering a coupon of LIBOR plus 2%. So whatever LIBOR is, they pay that plus another 2%. Now, what may happen is they may decide that rates are heading up, and so therefore this is not a good position to be in. But there's nothing they can really do about it. They've committed themselves to paying this to the bondholders. So what they could do is partially or completely eliminate this risk by entering into a swap, as we'll see in a minute, where they essentially are offering to pay fixed rates to the dealer and receive a floating rate in return, so that what they're receiving from the dealer is offsetting to a certain degree what they're paying out to the bondholders. Right. So the diagram will tell us what we need to know. So let's say they find a dealer who agrees to pay 6% or receive 6% from us in exchange for LIBOR. Okay, it would be dollar LIBOR. And of course, now it would be SOFR, but okay. Let's just say that this is the deal. So the corporation now, what is this diagram telling us? The corporation is paying, one more thing. Don't forget, the notional principal is $100 million. So the dollar amounts that we're paying will be determined by the rates of interest and that notional principal. Otherwise, we wouldn't know how much is being traded back and forth. So here, everything is listed as a percentage. The corporation has to pay LIBOR plus 2% to the bondholders, but the trade that they made with the dealer will provide us with LIBOR in exchange for 6%. So what that means is this LIBOR we receive from the swap dealer offsets the LIBOR that we pay to the bondholders. Then another 6% comes out of our pocket to the dealer and another 2% to the bondholders. So what we've basically done here is created a liability of not LIBOR plus 2%, but 8%. So because we've set this up, no matter what happens to LIBOR, we're going to end up paying a net amount of 8%. And if we're really convinced that rates are going up, that's going to let us sleep better at night, because we're pretty sure that LIBOR is going up, and therefore this could become more expensive in the future. Now, by the way, the actual trade of cash flows between the corporation and the dealer is not LIBOR and 6. What they actually do is they just trade the difference between the two. So, for example, if LIBOR goes up above 6%, the swap dealer pays the difference to the corporation. Or if the corporation, the LIBOR falls below 6, the corporation pays the difference back to the dealer. Okay, there's no point in, like, let's say, imagine I owe you $1,000 and you owe me $1,500. We don't actually trade 1,500 for 11 or 1,000. We just trade the difference, and that's what's happening here. Now, you're probably wondering, the dealer has now exposed themselves to the risk that LIBOR will go up. You can see that we're collecting 6% and we're paying LIBOR. So the dealer is not in the business of taking on risks. What they will do is they'll go out in the market and they'll find someone else to make a deal with, in which they can trade the LIBOR, the 6% they're receiving from the corporation for LIBOR, or possibly something slightly less than that. So let's just say that they find another counterparty to make a deal with, in which they trade or pay 5.95% and get back LIBOR. So you can see the dealer is collecting 6% from the corporation and paying only 5.95% to the bank. In exchange, they're receiving LIBOR from the bank and they're paying it off to the corporation. So the difference here is that 0.05%, and on a $100 million swap, that works out to, wow, $500,000. That's a profit that they've locked in. Now, what's the only thing that can go wrong here? If one of the two counterparties to this deal defaults, then the dealer could be left holding the bag. Okay, that would be the only thing that could really go wrong. But the dealer's job is to match up borrowers and lenders in such a way that the dealer always makes money, no matter what happens to interest rates in the marketplace. All right, so that's a simple example of an interest rate swap. By the way, the gap between what they're lending out and what they're borrowing here is the bid-ask spread. That's where their profits come from. This is how dealers make their money, from that spread. This is no different than currency, foreign exchange dealers. They always offer to buy currencies from you at a low price and sell them to you at a higher price. Okay, and this market is no different. Now, here's an example of how you might find this out. Let's say this is your dealer, and this is the quote that they give you. And what they're, if you notice what they're, oh, by the way, the letters BP stand for basis points. What is that all about? Let's just quickly run through that. This is sort of what, this is Wall Street terminology. Basis points are used to express interest rates. Now, the way it works is that 100 basis points equals 1%. So that 10 basis points equals 1.1%, and 1 basis point is equal to 0.01%. We'll see more of this later on when we look at other types of interest rate derivatives. Now, why do we need this convention? Why don't we just say the percentage? Well, here's why. It avoids ambiguity. Suppose, for example, the Treasury bond yield, 30-year Treasury bond yield, is 3%. If a trader announces that the yield has increased by 1%, this could mean one of two things. 3% plus 1% equals 4%, or 3% times 1.01, which is 3.03%. In other words, did it go up 1%, 1 percentage point, or did it go up by 1% of its current value? Well, it's hard to say with that phrasing. So here, the yield increased by 100 basis points. And here it increased by 3 basis points. So it should be clear, which is what you're being told with basis points, which may not be true with percentages. Okay, so I just want you to be aware of that. Now, so this quote, for a two-year swap, where you're thinking about entering into it as a fixed rate payer or receiver, TN stands for Treasury note. The Treasury notes are the ones that have maturities from 2 to 10 years. So what they're saying is that for a 2-year swap, we'll pay you the 2-year Treasury note yield plus another 20 basis points, which at the moment would make it 2.20%. On the other hand, and that would be in exchange for LIBOR, by the way, the dealer would receive 2 years plus 28 basis points, or 2.28% in this case. So the 8 basis points spread is the swap spread, and that is what goes into the dealer's pocket. So every time they do a deal, you see how they're receiving more and they're paying less because it's a dealer. Now, in the market, participants, they're willing to go along with this because it's convenient. They can go to the dealer anytime and either enter a fixed or floating rate swap on either side. And the dealer will say, no problem, here's the quotes. Which one do you want to do? So you're paying for the convenience here. The bid-ask spread goes into the pocket of the dealer, and you're basically paying them for their time. And so that's why it's set up this way. Okay, so that would be a typical set of quotes. Now, this corporation issued a bond. Yes. Go ahead, Larry. Uh-oh, what happened?
So am I there?
Yes, you're good now.
Okay. In the book, some of the examples they gave, both sides made out like exactly the same. Like, in other words, if somebody made out by 0.5%, then the other side made out by 0.5%. But then I think it said something like it doesn't always work out that way. Do they have to work out evenly, or do they just
No.
both have to find an advantage?
It depends on who's in the better bargaining position. You might have a deal with two counterparties. Like Hull's book has an example where one counterparty borrows in one currency, and then another counterparty borrows in another currency, and then they trade the cash flows with each other. And they end up being able to borrow more cheaply that way. But it doesn't necessarily mean that they're each benefiting equally. As long as each side benefits, they might go ahead and do the trade anyway. But it ultimately comes down to who's in a better position, because like if a small company gets to one of these deals with General Motors, well, you got to expect General Motors is going to wind up with most of the profits. Otherwise, they won't bother with the trade. So it depends on the two counterparties, what positions they're in, how much they're able to borrow, or at what rate they're allowed to borrow in their own markets. And so there's a lot of other considerations, but as long as they're both making money, they might do it, but there's no guarantee that they'll each benefit equally.
So do all three, you said the dealer benefits also, do all three, the two counterparties and the dealer, is it like a win-win for everyone?
Well, it's always a win-win for the dealer, because the dealer prices his swaps so that as long as you've got the two counterparties lined up, he's going to collect the profit from the two of them, but they can still profit if, depending on how they are exploiting the differences in their ability to borrow in different markets. Because usually the way they can make money is to borrow in each other's markets where they're not very well known, where they don't have very good credit. So the idea is that the one that has the best credit rating in one market borrows there, the one that has the best credit rating in the other market borrows there, and then they switch or trade the cash flows with each other. And so they may be able to both benefit from that if they set it up correctly. I guess, you know what, imagine, I'm thinking that, like, imagine if you have two people, one belongs to Costco and the other one belongs to Sam's Club. And each one of those stores has something the other one wants. And they agree to buy the product that they don't really want and trade it with the other person for the one they do want. And that way, both of them can save money, even though they don't belong to both Walmart, Costco and Sam's Club. Well, I thought of that analogy right on the spot. I like that one. So what they're basically doing is they are taking on positions that they wouldn't take for themselves, but they are able to use it to exchange something with a counterparty that makes both sides better off. Anyway, what do we have here? Oh, this corporation is issuing fixed rate bonds. 6% is the coupon on these bonds. They're 10-year bonds, but they were issued 5 years ago. So they're now 5-year bonds. But the corporation, since the bonds were issued, has changed its outlook, and now they're expecting a drop in interest rates. They don't want to be locked into 6% every year for the next 5 years. Okay, they're saying now to themselves, well, you know what? These bonds were issued when rates were much higher. They're costing us a lot of interest. So if only there was something we could do about it. So what they will do is approach a dealer, say, you know what, maybe we could get ourselves into a position where instead of paying a fixed rate of interest, we're paying a floating rate of interest. Because that way, if we're right and rates drop, we'll actually save some money. Of course, what's the drawback? If they're wrong and rates go up, they can end up paying more money. So it's a gamble, but they see that it is a worthwhile gamble. So let's say that they approach a dealer who says, sure, we'll do this with you. So remember, you are paying 6% to your bondholders. Here's what we can do for you. If you pay us LIBOR, we'll give you 4%. So how much is it costing the corporation now? Well, instead of 6%, they're actually going to end up paying LIBOR plus 2% more because they're paying 6% to the bondholders. They're only receiving 4% from the dealer. So that's going to right there, that costs them 2%. So the total cost now is, instead of 6%, it's LIBOR plus 2%. And so hopefully LIBOR won't go above 4%, because if it does, they're going to end up paying more money. Okay. If it stays below 4%, then they'll end up saving money. But it's definitely a gamble. Okay, comparative advantage. This is what we were basically just talking about, where two counterparties may be able to borrow in each other's or two different markets. Oh, sure. That's actually a pretty good idea. Let's say an American company has a division in a foreign country, and they might be able to borrow more cheaply by using their subsidiary to borrow in that country. But since they don't want that currency, they can then enter into a currency swap and trade that currency for dollars. So yes, it might be possible to do that. Absolutely. So yes, so that's what this is all about. Now, this is based on the logic, though, that you've got two companies who are interested in borrowing either at a fixed or floating rate of interest, and that each one, for whatever reason, is able to borrow at a more advantageous rate in one of the two markets. So in other words, if you notice, ABC can borrow more cheaply in the fixed rate market, XXX can borrow, well, actually, no, that's not right. ABC is more creditworthy than XXX in both markets. But if you notice, their advantage is more pronounced in the fixed rate market than the floating rate market. So in economics, we say that ABC has a comparative advantage in the fixed market, and XXX has a comparative advantage in the floating rate market. In other words, their disadvantage is smaller in the floating rate market. So ideally, XXX should borrow in the floating rate market, and ABC should borrow in the fixed rate market. So let's just say that that's exactly what they do. Where's the diagram? Here it is. But now the issue here, though, is that ABC is borrowing fixed, but they would prefer to be borrowing floating. Okay. So A XXX is the same thing. They are actually now borrowing floating, but they would rather have a fixed exposure. So what they do is they borrow in their market of comparative advantage, and then they trade the funds or the exposures, I should say, with each other. So let's see how that works out here. So ABC borrows the fix at 5%, XXX borrows LIBOR for 3%. Now they come to an agreement with each other, and this is what you were talking about. They have to agree to a rate at which they trade these funds that will benefit both of them. But it isn't necessarily going to be equally advantageous to both. For example, by agreeing to trade LIBOR for 3.5%, the net cost to ABC is LIBOR plus 1.5%, and the net cost to XXX is 6.5%. So ABC is paying a net LIBOR plus 1.5%. It would have cost them LIBOR plus 2%. Okay, so ABC has reduced their borrowing costs by entering into this agreement. So in other words, ABC is, like I said, I've switched computers tonight. I'm trying to find out how I draw in here. I'm not actually seeing any drawing tools. Okay, I'll have to look this up on the internet. I was before it was working in Word. It doesn't seem to want to work here. But anyway, the bottom line is ABC would have had to pay LIBOR plus 2% to borrow floating. Instead, their net cost is LIBOR plus 1.5%. So they're saving 0.5%. Now, XXX, on the other hand, is paying 6.5%. The net amount they're paying is 6.5%, and they would have had to pay 7%. So in this case, they actually did both make 0.5%. Okay, so, but it's just a coincidence. Like there's a total of 1% to be split between them. If one corporation is much larger than the other, they might have ended up with a deal that makes, let's say, 0.75% for one and 0.25% for the other. It doesn't have to be split right down the middle. But that makes it, I guess that increases the likelihood that both sides will accept it. Okay. But you know what? As long as they're both making money, they might go ahead and do this anyway. All right. So, I put a nice little chart here. They both saved 0.5%. You can see the borrowing costs, the payment to their counterparty, the payment received from the counterparty, all in cost is the net cost. Comparable means what it would have cost if they borrowed in that market, and therefore their savings are each 0.5%. So they're both very, very happy right now, especially if this is a lot of money. What if it's $100 million? 0.5%, as we saw, is a huge amount of money. And it's just because they got together and agreed to do this. And this is called comparative advantage. They're taking advantage of each other's market in which they have a comparative advantage. Now, in Hull's book, he makes the point, though, that theoretically, in an efficient market, this shouldn't actually work. But you never know. Markets aren't always perfectly efficient. So you could get these opportunities to save by entering into one of these swaps and borrowing in each other's markets in which they have a comparative advantage. All right, so pricing swaps. Now, this is where it gets very intense. We know that all these cash flows are going back and forth. So what we would like to be able to do is calculate the present value of all of those cash flows and determine which side of how much each side of the swap is actually worth to us today. Okay, so let's see. We're going to By the way, when the swap is first entered into, the rates are not just arbitrarily chosen. The fixed rate is supposed to be the rate at which the present value of all every day, actually. So if you ever look at a Bloomberg terminal, for example, where they have all these models for pricing, anytime you see interest rate swaps in there, there's going to be a price for one counterparty and the price for the other. One is always the positive of the other, and they always add up to zero, because it's, you think of it as a zero-sum game where the gains of one are the losses of the other. But we want to be very precise and figure out how much each one is worth. Oh, all right, let's go back and start this again. Yes. So in other words, let's see, maybe I can make up an example real fast on here. Suppose that two counterparties enter into a swap. We'll call them A and B or something like that. Okay, they could be anything. A pays 5% for LIBOR. Okay, which means B receives LIBOR for 5%. Okay, so I should be able to draw a little picture on here. For some reason, PowerPoint is not letting me. It's like I said, you just everything technology wise is a pain. Oh God. Well, I really just get so fed up with technology sometimes. It was working 5 minutes ago. Now it's just saying, nah, I don't want to do this anymore. God damn it. No, it just doesn't want to work anymore. All right. No reason, it just doesn't work. All right, I give up. I'll verbally tell you what's going on. God, what a joke. All right. All right, so anyway, the bottom line here is this. And it doesn't matter what the notional principle was, but initially, let's just say that at the time of the swap, LIBOR is 5%. So that means right now we're trading LIBOR for 5 when LIBOR is actually 5. Therefore, from both sides' perspective, the swap has a value of 0. The next day, LIBOR rises to 6%. Okay, so this means that A now has the position of A has improved. The position of B has worsened. So whatever the dollar amount is, if let's say A's position is now worth an additional $10,000. This means that B's position must be worth $10,000 less. So it knows they have to gain or lose the same amount. No matter what happens to the interest rate, one side has to gain, the other has to lose the same amount. All right, so what we're going to do, and by the way, that just means either one of these could be considered the price. The price could be considered $10,000 for A and negative $10,000 for B. So what that means then is that suppose that the two sides decide to offset this or unwind the swap, then B would owe $10,000 to A. Okay. Now that doesn't happen very often. You know, like with forward contracts, this is a legally binding agreement. But if the two counterparties get together and say, listen, that's it, let's just call a halt to this thing, it can be done. But the side that has the positive value would expect to be paid by the side that has the negative value in order to call the whole thing off. Okay, so anyway. How can we price an interest rate swap? Two basic strategies. Yes, go ahead.
Yeah, I apologize. I think one of the reasons why I put the question is you were saying something about which rate do we use? And I don't know if you were talking about the time frame, but I thought I read somewhere that sometimes they average the rates if it's over a time period. I don't know if that's what you were talking about.
It's probably the internet. It said, you notice how it says here, the internet connection is unstable. It's kind of funny how it's always unstable. There's never a time when it's not unstable. So anyway, so I'm sorry, I couldn't hear anything you said.
Can you hear me now?
Yes.
I thought you started out by saying something about they have to determine which rate to use. And then I think you said something, if it's over a time period, they might have to average the rate, or you said something, I didn't pick up what you said. Does that sound like what you were talking about?
You mean for choosing the rate for the swap?
Yeah,
Well, it's going to be whatever the current market conditions are. In other words, if I am entering into a swap and I'm paying 5%, the floating rate that's coming back to me on the first day of the swap will have to match up with the fixed rate so that the two sides are equal to each other. And then after that, the floating rate will change every day, and that will affect the value of the swap. But initially, the two sides are worth the same. It's like you're entering into a contract to trade two sets of cash flows that have the same values. And then after that, that can change every single, and it probably will change every day. So that's why there can be a price on a swap, which reflects the difference in the valuation of the two sides. Anyway, so there's two equivalent ways of pricing an interest rate swap. We can think of the swap as a portfolio consisting of a fixed rate bond and a floating rate bond. Now, there do exist bonds in the market where the coupon is actually floating, meaning that it changes every so often. For example, a bond that pays annual coupons and is tied to LIBOR, what that would mean is that every year the LIBOR rate is observed and the coupon rate on the bond is reset. So let's say on January 1st, the coupon bond is paying LIBOR. That means that whatever is the LIBOR rate on January 1st, that will determine the coupons for the rest of the year. Okay, so that's a floating rate bond. And of course, you wouldn't buy something like that unless you were pretty satisfied that rates are going up in the future. You don't see them very often. They do exist. It's not nearly as common as fixed rate bonds. But in effect, a swap, when you enter into an interest rate swap, what you're effectively doing is you're buying one of these bonds and you're actually selling the other. And we'll see how that works in a couple of minutes. Now, another option is something that you could do. There exists a type of forward contract, which is called a forward rate agreement. So what happens with one of those is that you're not agreeing to buy British pounds, or you're not agreeing to buy gold, or whatever the case may be. A forward rate agreement is a forward contract where the underlying asset is an interest rate. So what it basically lets you do is lock in the rate at which you can either borrow or lend in the future. So what we're effectively doing then with a swap is creating a series of these forward rate agreements. And so if we can price those forward rate agreements, we can price the swap. So we're going to see both examples in our template here. Let's see, what do we have here? It's all written down. All the details are in here. So we're going to set up a little table to show us how this works. Okay. So let's see. All right, here we go. Example, 6 months ago, a 4-year fixed for floating rate swap was entered into with a notional principal of $100 million. The floating rate is 1-year LIBOR. The swap rate or the fixed rate is 5%, and the payments are changed annually. So the payment frequency has to match up with the interest rates that we're using in the swap. So if we're using annual rates of interest, then we're going to have annual payments on the swap. Typically, they're every 6 months or every 3 months or every year, but they have to be consistent with the rate of interest that we're using. So how do we think of this as a portfolio of bonds? Okay. So what we have to do is imagine that if you are entering into this as the fixed rate payer, let's go back. Let me just quickly see if we have a graph of this. In this example, XXX is the fixed rate payer. ABC is the floating rate payer. We always describe the counterparties by what they're paying. So whoever's the fixed rate payer, in this case, is XXX, and ABC is the floating rate payer. So, and by the way, these payments that you're seeing here will be repeated every so often. Here, for example, maybe this is a 5-year swap where there's one exchange of cash flows every year. This can be arranged to anything that's convenient for both counterparties, but it's understood when you enter into a swap, there's going to be multiple cash flows. All right, and those are going to be tied to the cash flows of the underlying securities. And that, in this case, typically means coupon-bearing bonds. Well, now, so the fixed rate pair, remember, we're going to trade LIBOR for 5%. All right, we got two sides of the swap. One side is going to pay LIBOR, the other side will pay 5%. So the swap can be treated as a portfolio of bonds by treating the fixed rate pair's position as if they were buying a $100 million floating rate bond with a coupon of LIBOR, and then paying for this by selling a $100 million bond whose fixed annual coupon rate is 5%. So in other words, what are we saying here? Whoever is on the fixed rate side, whoever's the fixed rate pair, they're paying a fixed rate of interest to somebody else, and they're receiving a floating rate in return. So it's as if they sold somebody a fixed rate bond, which is why they're making fixed rate payments, and they're collecting floating rate coupons, which means that they must have bought a floating rate bond. So this position is equivalent to buying a floating rate bond and selling simultaneously a fixed rate bond. Okay, so it's as if the cash flows are the same as if we'd simultaneously bought a $100 million floating rate bond with a coupon of LIBOR, and we also then received $100 million back by selling a bond whose fixed coupon rate is 5%. So every year we pay 5% and we receive LIBOR. Now, what's important here too to note is that with an interest rate swap, we do not actually trade the principal. We don't trade bonds. The cash flows are only going to take place on the dates of the interest payments. And even then, it's just the net difference. So if we really owned this floating rate bond, and if we really sold the fixed rate bond, that's a different matter. We're really selling or making the cash flows to each other. We're also going to buy and sell or receive the principal $100 million. The floating rate side is the opposite. They're going to collect a fixed rate by owning a fixed rate bond, and they're going to sell a floating rate bond. Okay, so let's do it. Let's do a numerical example, and that's where this is going to come in so handy. So here it is, all the details. The notional underlying all of this is $100 million. And the coupon to the fixed rate bond is 5%, which means $5 million a year. The floating rate, now it'll tell you in here somewhere, the floating rate comes from the current level of LIBOR. So here's the current term structure of interest rates for LIBOR. Now, 6-month LIBOR is currently 4%. 18-month LIBOR is 4.5%. 30-month LIBOR is 5%, and 42 is 5.5%. They're all different. Now, those numbers in that chart are going to use, now, by the way, they also mention here somewhere that the current LIBOR rate is 3.5%. Where is it? Now, the fixed rate bond will make the following cash flow payments. $5 million will be paid out in 6 months or half a year and a half, 2.5 years, and 3.5 years. And then one final payment of the principal of $100 million in 3.5 years. So the cash flows look like this, okay? And these are in millions, by the way. In 6 months, $5 million. A year later, $5 million. A year later, $5 million. And finally, another year later, 105, which reflects the last coupon payment plus the repayment of the principal, or the amount that they used to buy this bond, $100 million. What are those cash flows worth to us today? Well, what we're going to do is calculate their present value. We talked about this last time. The present value tells me, let's jump aside a bit. The present value of a sum received in the future is, the amount that must be invested today in order to be worth that sum in the future. All right, so in other words, the present value of $1,000 to be received in 5 years when the rate of interest is, let's say, 3%, is, okay, so what you're going to do is take your 1,000 and divide it by 1.03, and then you'll have an exponent of 5 for 5 years. And so that would equal, okay, let me get out the old calculator. Hold on. My calculator's not helping. Okay. All right, let me just quickly do this real fast. 1.03 raised to the 5th power 862.61. Okay, in other words, if 862.61 is invested at 3% for 5 years, this sum will be worth $1,000 in 5 years. Okay, so therefore we say that 862.61 is the present value of $1,000. Now, when interest rates, as we discussed at one other point, are compounded continuously, in other words, the compounding frequency is infinite. Then the formula is different. What you would do then is you would take your $1,000 and you multiply E. Now, the exponent would be minus 3% for 5 years. And so that would give us hold on one second. $860.71. Okay, so when rates are compounded continuously, the present value of the sum is only 860.71 because the investor earns more interest with more frequently compounded interest rates. So in other words, the reason why it's a smaller amount that you have to put aside is because you're earning more interest this way. Now, I just want to mention that all my notes are taken from John Hull's book. And Hull, you know, and just in general, derivatives pricing models tend to be based on continuously compounded rates of interest. But even when they're not, Hull just loves continuously compounded rates of interest. So he often uses them as examples, even when it's not really the way it's done in the real world. So this is no exception. We're going to assume that these interest rates that I showed you are continuously compounded. So we already know in advance what the cash flows will be to this fixed rate bond. What you're seeing in the exponents is the rate that applies to that maturity, 4%, 4.5%, 5%, 5.5%, and the number of years is multiplied by that. And so if you plug these into your calculator, you'll see that the price of this fixed rate bond in the market should be $100.59 million. Okay, so that's the fixed rate bond in this. Remember, we said before that an interest rate swap is essentially a trade of a fixed for a floating rate bond, or vice versa. So we need to calculate the price of both bonds to come up with the value of the swap. So let's go back to our spreadsheet. And you can see we got the 5%, we have $5 million. These are the interest rates that I just showed you. And so what we're going to do here is calculate, now the discount factor, this is basically, think of this as the present value of $1 in each of these cases. So in other words, for $1 received in 6 months, and the rate of interest is 4%, then it's 0.9802, which means every dollar that I want to receive in the future must cost me 98.02 cents today. Okay, so the formula is right here, by the way. I can do the same thing for all 4 of these time slots. All right, those are the times at which cash flows will take place. These are the so-called discount factors. Now, why does this matter? Because in order to come up with the present values of these cash flows, all I have to do is multiply them by these discount factors, and I get these numbers right here. when I add them up, it turns out that the fixed rate bond has a current market price of $100,601,019.89. Okay, that's the fixed rate bond. Now, the floating rate bond, we don't know what the future cash flows will be, but we do know that the value will reset every year rather, and it will then have a value of exactly $100 million. So it turns out that the only number we need, you know why? Because the bond was issued 6 months ago. And so from today's perspective, the next coupon will arrive in 6 months. So think of those as, when is the next cash flow going to arrive? The time doesn't mean at what time are we observing this. It means the time at which we'll receive a cash flow. Okay, that's why the first one is 0.5. The first cash flow is due in 6 months. And then a year after, and a year after. All right, so now on the floating rate side, the only cash flow that we know with certainty is the next one, because then after that, the following one will depend on LIBOR at the end of this period. Okay, so in 6 months, we observe the LIBOR rate. That will determine the next cash flow and the next one and the next one. But on each of those reset dates, the value of that bond will be exactly equal to the original $100 million. So it turns out that in order to price the floating rate bond, all we need to know is what is the present value of the next coupon plus the notional amount of money invested in this bond. That is 103,500,000, because we're assuming that 6 months ago, when the bond was issued, the rate was 3.5%. Okay. So what that means then is that the floating rate bond is worth 101,450,562. Now, they're not the same. So right now, the fixed rate payer, because they own the floating rate bond, but they are short or have sold the fixed rate bond, the value of their position is the 101,450,000 minus the 100,601,000, which means their position is worth $850,000 roughly. Then that means that the floating rate pair is in the opposite position. We don't even have to do any calculations here. It's just the negative of this one. And so these two have to add up to 0. That's why that's there. So in other words, if the floating rate pair approach the fixed rate pair and say, hey, listen, can we unwind this swap? I don't want to do this anymore. The fixed rate pair would say, sure, but you owe me $849,542.79. Okay. So the two sides always add up to 0. And in this example, the difference between the two bonds values is what determines the value of the swap, because the cash flows are equivalent to having one side owning a floating rate bond and the other owning a fixed rate bond. So, there's more details down here, but so when you get to your assignment, basically all you have to do is change these numbers. Let's see, where is that? Let's go get it. Just so you can see what you're expected to do. Oh, no, that's not what I wanted. I'm looking for, see, I'm still getting used to the Mac, how they hide all these websites. Oh, there we are. Okay, so let's look at the template for assignment 3. Now, this is, no, that's not going to do any good. That is not, Oh, for God's sake. Why is it doing this? All right, I don't know. This is supposed to be an Excel spreadsheet. Why is it doing this? This is really starting to really aggravate me to no end. All right, well, I guess we're gonna have to get rid of it because this is not what I wanted. I'm just gonna go ahead and get the real thing. God, this is unbelievable. All right, so the template is right here. You can see it's an actual honest to God Excel spreadsheet. See, now I'm not sure what to expect. I'm going to try to open it up and see it and make sure that it is in fact an Excel spreadsheet. This is really aggravating me. No, it's a PDF. Why is it doing this? This is what it really looks like. You can see it's very, very similar. The only thing you're actually changing is some of the numbers. But if it refuses to let me download it as Excel, has this happened before? Has any of the other material? Well, I guess this might be our first spreadsheet. Maybe that's what the problem is. Why wouldn't it let me use? It's the same thing here. I have no idea what the problem is. It's not letting me give you. All right, I'll tell you what, I'll just email them to you right now. If it's that stupid and incompetent, I'll tell you what, I'm going to make a note to myself. It's just beyond belief. But I mean, I know all technology is designed to frustrate us, but that's just absolute nonsense. That is just unbelievable. All right, so I'm just going to delete these right now and I'm going to email them out to you, which is while I'm thinking about it. All right, actually, I'll wait till break time to email it to you, but I'll open it up from my copy. This is what it looks like. They're very much all derivatives are off balance sheet. They're all in the same category. They are listed. They should be listed in footnotes. They're not going to be part of the main body of the financial statements. They would be mentioned in a little tiny footnote at the bottom. I think that's partially because they're a very different type of exposure than, let's say, accounts receivable or inventories or something like that. But right now, at this point in time, financial statements only show derivatives on footnotes. So, yeah, it's just because they're a very different type of product. But anyway, so here is the template for what we're doing in the notes. And then there's another template, which I'll send you because it's obvious that Brightspace can't handle this. And I'll just separately send that to you. But yes, so your assignment is set up to look exactly like this, where you're really just changing the numbers. Even, I think the formulas are even still in there. Let me just confirm that. No, they're not, but you can copy them from here. Okay, so notice, you see how it's identical, it's virtually identical. Okay, so it's, yeah, it's all done to be as convenient as possible. So, yeah, so we had two problems. Let me just make a note of this again. When I did handwriting, it disappeared the first couple of times. So that I just want to make sure this doesn't keep happening. And I'll call them tomorrow and see what's going on. All right, so all that information I just gave you for pricing a swap, this is how we organize it. Okay, so we're going to have a column for the floating rate cash flows, the fixed rate cash flows. We're going to calculate their present values, add them up, compare them to each other, and that's how we tell them apart. That's how we can figure out which is worth what. Okay, the two of them always will have opposite signs, and the two of them will also add up to zero. So the gains of one are exactly offset by the losses to the other. All right. So and the details are here as well, you can see, but the formulas aren't listed here, but they're in the slides. So that is your standard interest rate swap. Like I said, this is the most basic type. There's so many other ways it could be organized, but this is the typical fixed for floating rate swap. Now, currency swaps are a little bit messier because we're dealing with two different currencies, and the although the interest rates are typically fixed. It doesn't have to work that way, but you might find yourself trading dollars denominating, let's say the treasury, the Fed funds rate, let's say in dollars versus the equivalent policy rate for British pounds. That kind of thing could be done. Now, with an interest rate swap, by the way, I just want to remind everyone that you don't actually trade the notional principal. So when I enter into the swap here, for example, all I'm doing is making the payments. And even then, just the net difference between them. The $100 million is never actually going to trade hands. Okay, there'd be no point because it's the same amount of money. It's the same currency. Currency swaps are different because the motivation for entering into this currency swap may be to acquire the foreign currency that you need to invest in, let's say, a foreign bond. And so part of the reason, oh, yes, go ahead.
So when you are at the end of this swap, so like 3.5 years,
Right.
why the coupon rate, I mean, the coupon amount is going to be like the notional plus the coupon, because that's when the notional is going to get exchanged, or it never gets exchanged?
Well, yes. No, now here, remember what we're doing here. We're treating this as a fictional bond. Okay. So this amount would be the same for both sides, but we're going to, we set it up like this so that these are the cash flows that a fixed rate bond would have. You notice how here in the floating rate bond, we also added the $100 million. The difference between the two is when they're received. So if we're going to treat these as a fixed rate bond and a floating rate bond, we have to be consistent with the actual cash flows they would pay if we actually own those bonds. Okay, so in other words, here we're not actually trading the notional principal, but the values of the bonds themselves do depend on the principal as well as the cash flows, the coupon payments. So that's why we have to leave them in, because they're not occurring at the same time, and that would affect the pricing of the swap. So remember, this is a fictional portfolio that we're creating. where we own one of these bonds and we've sold the other one. So the cash flows have to match up with what these bonds would actually pay in order for our model to work correctly. Okay. Anyway, so the currency swaps, we are actually going to trade the currencies themselves, the notional that is, and the notional will be in two different currencies. In other words, you might be trading dollars for pounds, for example. And so in the beginning of the swap, you'll trade the notional principals, and then at the end, you'll trade them back, because each side may be interested in acquiring the foreign currency from their perspective, and then earning interest along the way. So here we have a corporation in the US wants to buy a 5-year 100,000 pound bond with a 6% coupon rate issued by a UK corporation. But we don't want to be exposed to foreign exchange risk. In other words, if you own a pound denominated bond, you might get a very nice rate of interest, and yet you might end up losing a lot of money if the dollar gets too strong, okay, while you're holding this bond, because then each pound would be worth fewer dollars. So what are we going to do? What we can do is enter into a currency swap where we first trade dollars to get those pounds, and then we trade the pound denominated coupons for dollar denominated coupons. So in effect, what you're doing is you're trading a US dollar bond for a UK British pound bond. So, but we have to be careful. We have to make sure the currencies are consistent with each other. So if we did own this bond, that means we're earning a 6,000 pound note coupon every year. And let's say that at the moment, the exchange rate is $1.90 a pound. That translates into $11,400. We're supposed to get one of those every 5 years. Now, if the dollar fluctuates and we have not entered into a swap, if the dollar gets stronger, drops down to 180 per pound, that payment is only worth now $10,800. We don't want that. We're worried about this. So therefore, we enter into a swap where we pay a fixed rate based on pounds, and we received a fixed rate based on dollars. Okay, so we're hoping that we end up earning a rate of interest that's denominated in dollars because we don't want any foreign exchange risk. Okay, that's always our motivation with these. We want to avoid foreign exchange risk whenever possible. So let's say we find ourselves a swap dealer and we agree to pay 6% in pounds in exchange for 5% in dollars. And let's assume that the spot rate between the dollar and the pound is $1.90 per pound. So therefore, what's going to actually happen with this swap? We're going to trade $190,000 to the dealer. They will then give us 100,000 pounds. These are used to buy the bond. At the end, we'll reverse this amount. In other words, we will give them back 100,000 pounds, and they will give us back our original $190,000. So this is the this is what it looks like. So the diagram doesn't actually show the exchange of principal, but the corporation bought the bond. They traded dollars to the dealer for pounds. They bought the bond. They collect the 6% coupons in pounds. They trade them off to the dealer, who then gives them in return 5% in dollars. When the swap ends in 5 years, then we'll reverse the notional principal. We will give them back 100,000 pounds, and they'll give us back $190,000. So therefore, we're guaranteed that every year on our investment of 190,000 US dollars, every year we'll get a coupon worth 9,500. And that's that. Now I believe that's the example in our template. Let's just confirm that. Yeah, this is the one. The bonds, we have the two fixed rate bonds, dollars and pounds. The dollar bond in the US is worth 190,000. The pound bond is worth 100,000 pounds. So here I've got the coupon rates in the two countries, and the coupon for a $190,000 bond is 9,500, which is the same as 5,000 pounds. And over here, for the British bond, it's a 6% coupon, 6,000 pounds or $11,400. Oh, and by the way, the rate of interest in the two countries is 3% and 5%. So the swap is being priced as if the US corporation is buying a dollar bond with a face value of 190,000 and a 5% coupon rate, and simultaneously selling a UK bond with a 100,000 pound face value and a 6% coupon rate. Now, if you look at this chart, here's the US bond. These are the cash flows that are supposed to be received. A coupon of 9,500 each year for 5 years, plus repayment of the original principal of $190,000. In Britain, this bond pays a 6,000 pound coupon every year. And at the end, there's also the repayment of principal of 100,000 pounds. So, oh, by the way, this is the diagram in case you forgot. The present value is calculated based on the US rate of 3% here and the UK rate of 5% here. So if you notice, we're using values of these dollar coupons and the British pound coupons. So at the end, we have the price of this bond in dollars should be about 206,000. And the pound bond is worth about 103,765 pounds. Now, if I multiply the pound price by the exchange rate, that means that the price of the pound bond is only $197,000. So if I'm the owner of the US bond and I've sold the UK bond, I'm ahead by about $9,000, $9,800. So this is the side of the swap that owns the dollar bond and has sold the pound bond, which means that you're the one who's paying pounds and receiving dollars. So you can see that's the US corporation. They're paying pounds and they're receiving dollars. They're the ones who are ahead by $9,830. The other side of this contract, the swap dealer, is in the opposite position. They have the short position in the dollar bond, long position in the pound bond, or in other words, they're paying dollars for pounds. And at the moment, those dollars are worth more than the pounds. And so therefore the dealer has a position worth negative 9830.09 instead of positive like the US corporation does. Okay, so this is one potential way of pricing a swap, a currency swap. We're going to just line up all the cash flows in the two currencies, calculate their present values, and compare them to each other after adjusting for the exchange rate. The difference between the two tells us who's ahead and who's behind and by how much. Okay, so just two bonds, a dollar bond, a pound bond. The US corporation is equivalent to owning the US bond and selling the British bond and vice versa for the dealer. So that's what this approach is all about. Now, the second potential approach means we can treat our swap as if it were a sequence of forward contracts. Okay, forward contracts, foreign exchange, specifically foreign exchange forward contracts. All right, so let's just take a look at the notes. By the way, here's another example when you might want to enter into an interest rate swap. I'm sorry, currency swap. What's happening here? and then we'll get back to the other swap, is that an American company thinks they can save money by borrowing yen and swapping them for dollars. So here's why. Because they would need to pay 1.5% to borrow in the US. And they could pay only 0.5% in Japan. It's a multinational that does business in both countries. So they have the ability to borrow at 1.5% in the United States, 0.5% in Japan. So what they hope they can do is borrow at 0.5% in Japan, but since they don't want yen, they want dollars, they can enter into a swap to trade the yen for dollars. And so by doing so, they'll make a profit, which will reduce their borrowing costs. So here's the diagram. Now we're assuming that the notional principal is 100 million yen, which is worth $1 million US. All right, now. That means that the US corporation, because they're borrowing at, they're paying 1% to the dealer in the swap. They're getting back 0.5%. Now, they've set it up very wisely because if you can see, they borrowed at 0.5% in yen. So what they were hoping to do is collect that 0.5% from the dealer and then pay some US rate to the dealer in dollars. So, and that's what they've done. Now, remember, so what this means is their net borrowing cost is 1% in dollars. They would have had to pay 1.5% to borrow in the US. Instead, they've been able to reduce that to 1% by borrowing the yen and entering into a swap in which they agree to trade dollars for yen. So again, this is one of those cases where some people would say this really won't happen in practice because it would indicate that the markets are inefficient, but that doesn't guarantee that these opportunities don't arise. So you might find situations where it's possible to lower borrowing costs by borrowing in a foreign currency and then turning around and swapping out the foreign currency for the dollar. Okay, so that would be just another example when a currency swap could be very helpful. Now, the pricing, as we've already started to discuss, we can treat it as an exchange of two bonds, a dollar bond for a pound bond. And then if we do that, this US corporation, let's go back to that example. Is entering into a foreign exchange swap. Remember, the US corporation wants to buy this British pound bond without exposing themselves to any foreign exchange risk. So what they're going to do is they will trade dollars for pounds, buy the bond, and then trade its cash flows for dollars. And that's what we saw here. So in other words, they want to lock in 5% in dollars without exposing themselves to any foreign exchange risk. So they bought the bond, they trade those cash flows to the dealer, and they get back dollars. So in effect, they're selling a British pound bond to the dealer, and then they're buying a dollar bond from the dealer. So that's why this chart tells us what we need to know. Here's the cash flows from the dollar bond, which we now own. And here is the pound bond, which we now have sold. And so the value of the swap comes down to the difference in the prices of the two bonds as of today, which is why we're using the current spot exchange rate. So we saw that the corporation is ahead by $9,800 and the dealer is behind by $9,800. Now, what they're going to do here is make the point that there's an equivalent way of doing this that doesn't involve bonds at all, but instead forward contracts, specifically foreign exchange forward contracts. So in order to do this, we need to go back and quickly review. I'm not even going to go to Brightspace. I'm going to go find mine. Our discussion last week about forwards, you might recall, included as an example foreign exchange forwards. And where's that example? Hold on. I know it's here. I know it's here. Here it is. Okay, this is the one. This is the general case when there's some kind of cash flow being paid to the asset underlying the contract. If this is a foreign currency, then Q becomes the foreign rate of interest. So here's the example we used. And you can see the forward price of the pound is equal to the spot price times E to the R minus Q. R is the US rate, Q is the British pound rate, T is the time to maturity. So this number is the forward exchange rate between the dollar and the pound for 6-month delivery. And so we could also imagine that we could get a quote for another contract, which expires 6 months later and then 6 months later. So it's these forward prices that we can also use to price a currency swap. Okay, so it's a bit of a different approach, and you'll see you always end up with the exact same results. Okay, but just keep in mind, this is what we're doing. We're using these forward exchange rates to come up with the appropriate price of a currency swap. So here we go. Where were we? Oh, yes, here it is. So that's the first approach. 2 fixed rate bonds, 1 in each currency. And then that's what we've done. And then the swap is a portfolio, I guess you could call it, of foreign exchange forward contracts. Now here, in order to do this, we need to know what interest rates are in both countries for all maturities. So in Hull's book, he often makes the simplifying assumption that the yield curve is flat, which means that the rate of interest is the same for all maturities. So we'll do that here. Also, you notice how he loves to assume continuous compounding. And so we'll do exactly that too. All right, actually, okay, wait a minute. Here it is. Yes, we can do this. The swap can be priced in terms of foreign exchange forward contracts in the following way. Okay. Oh, actually, before we do that, I see that it's getting kind of late here. Maybe we should have our break real fast. And then we can come back to this example. So why don't we knock it off for 20 minutes or so, which is our standard break. And then when we get back, we'll go through this example where we're pricing a currency swap as a series of forward contracts. And you'll see that it has to give us the same result as if we were simply trading 2 bonds for each other. Okay. All right. So we'll come back at about 8:25, and then we'll carry on with this example. And then we'll look at the other forms of swaps. All right, here we are. So this format will prove to be very important in what comes next. Well, yes, you can use their forward rate agreements where you can enter into a contract to lock in a rate at which you can borrow or lend in the future. Okay, so in other words, they're very similar to forward contracts written on, let's say, currencies or gold, but this time the rate of the underlying security is an interest rate. So if I enter into, let's say, a forward rate agreement, let me just put together a quick example of this. With a forward rate agreement, which is just a forward contract written on an interest rate. Okay, it's the same thing. The title is slightly different, but an investor can lock in a borrowing or a lending rate. All right, so in other words, let's say, for example, suppose that a corporation needs to borrow $1 million or will need to borrow in 6 months in order to avoid the risk that the rate will rise. The corporation can enter into a forward rate agreement as the borrower. Now, let's just say that the rate of interest agreed to in the contract let's say it's, I don't know, 5%. So what that means then is that in 6 months, if the rate has risen, let's say to 7%, the corporation will still pay 7% for their loan, but the counterparty to the FRA will pay them the difference times the $1 million, which is $20,000. Okay, so in other words, they're still going to pay the full borrowing costs, but then the contract will provide them with a cash payment of $20,000. This reduces the borrowing cost to 5%. So even though they actually pay the full amount, the net effect is that they're only going to pay 5% for this loan. Now, at the same time, though, if the rate drops to 4%, the corporation must pay, all right, the corporation will borrow at 4%, but will then owe 1% to the counterparty so that the net borrowing cost remains at 5%. So in other words, what they've done is they've locked in a 5% rate regardless of the actual rate of interest. In one case, the rate goes up and they get paid by the counterparty. In the second case, the rate goes down and they have to pay the counterparty. So this way, no matter what happens to the rate of interest, their borrowing costs will be 5%, no more, no less. That's a forward rate agreement. So now there do exist, by the way, futures contracts written on, let's say, treasury bonds and other types of interest-bearing securities. So in the derivatives markets, there are many interest rate products that can be bought to hedge interest rate risk, but this is the most direct way. It's the easiest way to hedge our risk with a forward rate agreement because we choose the rate which we can borrow or lend, and then we lock it in, and that's the end of it. With treasury bills, the problem with treasury bills is that then the contract is based on the price of a treasury bill, which is inversely related to the interest rate. So hedging strategies are a lot trickier. So, for a simple type of hedge, you might be better off with a forward rate agreement than some type of futures contract. Okay, but they do exist if anyone's interested. So, all right, anyway, so that's what that's all about. By the way, the difference though, between here and the swap is that here we only have a single exposure. If you were going to borrow not in just 6 months, but every 6 months for the next 5 years, then you could enter into an interest rate swap where in effect, you're doing the exact same thing. You're locking in the rate of borrowing every 6 months for the next 5 years. The rate goes up, you get a payment. If the rate goes down, you make a payment. So an interest rate swap is really no different than a sequence of these forward rate agreements. So that's how that works. All right, then. I think we're going to run into that again in a later chapter because we also find options that are available on interest rates, and we can use those to hedge interest rate risk. All right, let's get back to this. We have this last example where we're going to price a currency swap by treating it as if it were a portfolio of foreign exchange forward contracts. And remember this formula. This is the one we used for calculating the forward exchange rate between two currencies. So we're going to do the same thing here. And the second approach to calculating the price of the same exact swap, if you remember before, it was worth 98.30 rather to the corporation and minus 98.30 to the dealer. All right, so how could we calculate this using forward prices or forward contracts? All right, so the same information is on top up here, if you notice. Except that actually, no, what we're going to do here is take the cash flows to the two bonds. Yes, they're over here now, but we're not going to calculate their present value just yet. Here's what we're going to do. We calculate the forward exchange rate using this formula that we just saw. Okay. And we need, now here we're going to make it a simple assumption that the US rate is 3% for all maturities and the UK rate is 5% for all maturities. And furthermore, they're both continuously compounded. This is what Hull loves to do. So we'll use this formula to come up with these numbers. Okay, so if you want to pop that into your calculator, the only thing that separates one cash flow from another is the time. All right, so this first cash flow is in year 1, year 2, 3, 4, etc. And so in this formula, you notice it's F equals S e to the R minus R star T. The T is what's different from each of these, in each of these cases. So that means we have the actual cash flows in the two currencies. Here's the forward exchange rate. And so what's going to happen here is that we're going to calculate the dollar value of each of these British pound cash flows by converting them into dollars using the forward exchange rate. Okay, in other words, this 6,000 pounds occurs in 1 year. So we're going to use the 1 year forward exchange rate to determine how many dollars that will be worth. Same thing here, number 2. Number 3, they're all based on the forward exchange rate. We're going to convert this many pounds into this many dollars. And so these are the cash flows that we would expect the bond to have, not denominated in pounds, but in dollars. Now, the net cash flow is the difference between columns B and E, because remember, this is the cash flow to the dollar bond. This is the cash flow to the British pound bond, where both of them are now expressed in dollars. In fact, we probably should have turned this into dollars here, but I didn't. And so now here's the difference between the two. Remember, we own the dollar bond and we've sold the British pound bond. So, so here, for example, we own a bond that's paying us 9,500. We've sold a bond that is providing a cash flow of 11,174.26. So from this time period, we're down 1674.26. And in fact, if you notice, we're behind in all 4 cases except the last one, where we're quite a bit ahead. Now here, we're calculating the present values of these dollar cash flows using the US rate of interest. And so when you add them up, you see a number that you've seen before. This is the 9830.09. This is what belongs to the owner of the US bond, and this is the dealer's position. Okay, so it's a slightly different way of getting to the same results. It's still based on the logic that these cash flows values depend on the current spot exchange rate and the future interest rates between the two countries, but we're actually calculating it in a slightly different way, and yet we end up with the same results. So what this demonstrates is that a foreign exchange swap or currency swap can be thought of as an exchange of two bonds or a series of forward contracts written on the foreign currency. Either way, we end up with the same result. So in your assignment, you'll be able to take different data and plug them in here, and you should be able to use this as a guide, use the same formulas, and you should get the correct results. But along the way, as you're entering the numbers and trying to see what you're doing, you'll start to gain some insights into what exactly we're doing here. So you can see starting from scratch would have been very unrealistic. So doing it this way with a template is going to be very helpful. So that's why we have all this information this week, so that it help you set up your spreadsheet so that you can figure out the correct prices for these securities. In fact, why don't we take a quick look at the questions? There it is. So yeah, you're going to have a chart with maturities and LIBOR, just like we did in our example. And this is an interest rate swap. And it says use the exchange of bonds approach to answer this question. That's exactly what we did. Then we're going to have a foreign exchange swap. And here we're going to use, again, the exchange of bonds approach to come up with a correct price for this bond, the swap rather, to the financial institution and the dealer. Okay, so you're actually only doing two things: one interest rate swap, one foreign exchange or currency swap. Okay, so that won't be too bad using the template. Now, what's next? Oh, this is, yeah, we're done with this. Oh, I clicked off the wrong one. Hold on. Okay, where did we leave off? Hold on. Other swaps, yes. Thing, a credit default swap is one where one counterparty makes cash payments to the other counterparty. And if a bond, all right, let's take a step back here. Imagine you're an investor, you own a corporate bond, and you're worried that the company might go out of business and your bond will become worthless. So what can you do about it? Well, with a credit default swap, what you're basically doing is you're buying an insurance policy on that bond. So you might enter into an agreement to pay X dollars a year to a counterparty. And then if something goes wrong and your bond loses a lot of value, then you'll get a payment from the counterparty. Okay, so you're paying a stream of payments in exchange for potentially at least some kind of a payoff if your bond loses a lot of value due to typically some kind of credit event. So it's a little bit different, but it's still a type of swap. And they're very controversial because, you know, the way they were misused during the recent credit crisis. But I don't have them listed in this chapter because these are all meant to be swaps that help us manage what we call market risk rather than credit risk. Credit risk is a very different ballgame. And in fact, I don't know if they have a separate course in credit risk, but there's a lot of derivatives whose purpose is to hedge credit risk rather than what we call market risk. So in other words, not the risk of changing interest rates, not the risk of exchange rates going up and down, that kind of thing. Instead, the risk that lenders or borrowers rather will not make the payments that they promised on time. But anyway, so here, still within the field of market risk, equity swaps, with this, what you can do is, let's say that you own a portfolio of stocks which are not performing terribly well. Which means capital gains plus dividends. And you'll send back to me, let's say LIBOR plus 2%. So when would you do this? Well, if you have reason to believe that the market is going to be flat and interest rates might be heading up, then you might want to take advantage of that outlook by entering into one of these equity swaps. Okay, so again, the motivation is to change the type of exposure you have without selling the actual stocks. So, you never know. This is something you can use as a portfolio manager to temporarily change the types of assets that you have exposure to. For example, a pension fund owns $1 million worth of IBM stock, and they're worried about IBM, but they don't want to sell the stock either. So they enter in an equity swap, which they trade the returns to IBM for LIBOR from a dealer. At the end of each year, the difference between the return of the IBM stock and the LIBOR is exchanged between the two counterparties. So what they've done is they've exchanged this risk of the stock not doing well for the risk that rates may actually fall in the future. And so, they're obviously going to do this only because they're convinced that rates are heading up and or IBM is going to have a rough next couple of years. Commodity swaps. Now, commodities are standardized products like, precious metals sometimes are thought of as commodities like gold and silver, but often commodities are more standard products like, let's say, zinc or nickel. As far as metals are concerned, it also could include agricultural commodities like coffee and soybeans and pork bellies and that type of thing. So just think of a commodity as a standardized product where the product itself is not actually being sold to consumers directly, but used to make consumer goods and services. So here we have potentially fixed for floating rate commodity swaps and commodity for interest swaps. For example, the fixed for floating means we trade the returns to a set of commodities or find some kind of a published commodity index and trade that number for floating rate of interest. So there do exist commodity indexes, and they're just numbers that reflect the returns to a basket of commodities. So they're like, for example, there's a Dow Jones Commodity Index. There's a few others. Bloomberg has one. GSCI belongs to Morgan Stanley. There's several of them that we could use. Okay. So those are all going to be based on commodities like corn and crude oil and copper and soybeans, that type of thing. So the Commodity Research Bureau produces an index called the CRB Spot Index, which reflects the prices of commodities like metals, textiles, foodstuffs, etc. So we can trade the returns for floating rate of interest. And we can also, well, actually, in principle, we could trade it for anything we want, but it's often the case we're going to trade it for a floating rate of interest. Now, here's an interesting type of swap. This is sort of a hybrid between forward contracts and swaps. This is a swap that is not going to start until some point in the future. So we call it a forward swap. Okay. Or you can think of it as a forward contract, which is written on a swap. So it gives you the right to enter into a swap at some point in the future where the details are fixed in advance. Like for example, if it's an interest rate swap, the swap rate is set in advance. A long one means that you are the one who's going to enter into the contract as the fixed for floating rate payer. And then the swap rate is fixed in advance. A short forward swap means you're going to enter into the swap as the floating for fixed payer. Just the opposite. So see, it's not exactly the same as what we're used to seeing. Usually the long is the one who's buying something and the short is the one who's selling something. Here, I think somebody decided that long means from now on fixed for floating and short means fixed for floating. It was kind of an arbitrary decision, which is which, but it's a little bit different than what we're used to. Like I said, where long means we're buying something and short means we're selling something. Oh, that was the last one. All right. So here's what we need to do. You're going to do those examples based on those templates. Now, next week, we're going to move finally into a very intense, complex, but exciting world, which is options. And, you know, I don't know about, well, you'll make up your own minds at the end of the course, but I personally think that options are far more interesting than forwards, futures, and swaps, partially because they're very complicated, but partially because they're very powerful and they're much more flexible than the other three. But the trade-off is that we have to buy options. Okay, forward and futures contracts, swaps, they're just agreements. You're not really buying them. But here you are in fact buying the options. So that, you know, a lot of the complexity with options comes down to the pricing models. But when you see what they're capable of doing, you'll be amazed at the different strategies that you could use to hedge your risks with options as well as speculate with them. And if you look at the topics that are coming up, you'll see that pretty much we're going to spend the rest of the course with options, except at the end, we're going to introduce something called value at risk. But it's going to take us several weeks to look at the properties of options and how they can be used for hedging and pricing, and for also how to measure their risk. Okay, so it's going to be very exciting, but these are important too. But I think you'll really find that options are very, very interesting, very exciting. And you know what's interesting about them is that you can analyze them to a great extent with equations, of course, but also with graphs. In this area, graphs are very, very helpful in analyzing the positions of swaps. And we're going to see a lot of graphs in the next few weeks to help us understand what our strategies are with options. Anyway, I guess we better knock it off here. So let's see, I'm not sure if I need to post anything else, but next week's material is already there. You can go look at it now if you want to, in Brightspace, that is. So I guess we'll just call it here, and then I'll see you all next week at the same time and same place. All right.
And please, can you send the assignments for this week, but via email?
Oh, yeah. Oh, are the Word documents not working here either?
It was the Excel templates that were.
Oh, that's right. That's right. Because yes. I'm glad you reminded me. Yeah, I'm going to call them up tomorrow and ask them what's going on with that. But yes, I'm glad you reminded me. I will send you by email the Excel templates that you need so you can get your work done.
Thank you.
Okay.
Can I just ask one final question?
Yes.
Is there a certain day that you're more available than others? Like in case I have a
The
question?
weekends are much, much better than the week because I typically have night classes and day classes during the week. The weekend is much more wide open.
Okay, I'll keep that in mind.
Yeah. Like to me, the perfect time to do this kind of stuff is Sunday mornings.
I mean, would that be through email, like a question through email or?
Yes, that too. You can always do that.
Okay,
All right. Anyway, yes. So I'll see you all next time.
Thank you.
all right,
All right.
thank
Good
you.
night, everyone.
Good
Good
night.
night.
All right. Bye.